Nike stock has been down big after hours. They just reported they missed on revenue, but beat on earnings. With some bad guidance coming forward, they're going to write down some inventory. What does that mean? When you write down inventory, they say, listen, we have too much stuff here. We need to get rid of this crap so we can bring the new stuff in and start selling the new stuff at a higher price. So that's not good for the future, but it's a temporary problem. Nike is down, like I said. Okay, it was down 4.15 just minutes ago. Now it's only down 3.45, 3.36. Guys, in this video, we have things for beginners and we have things for the advanced investor. Stay the entire time. You're going to have something in here to think about. And if you've watched our videos before, keep watching them. It's all about repetition. It's all about teaching a process. I do not own Nike stock. It is on my list of companies I'd like to own forever. Nike is a great brand, and we're going to show you some of the things that make it very attractive for me. So let's start by looking at the higher level things. We're going to go through some high level items through our 8 pillars, analyst estimates, and then we're going to go through our stock analyzer tool. And that's the most popular part of our video. And the reason being is, of our software in general, the reason being is that our stock analyzer tool allows you to make assumptions about the future, and it'll tell you what price to pay for the stock based on those assumptions, because every investment is the present value of all future cash flow. You are not buying a ticker going up and down. You are buying a piece of a business, and it's super important that you remember that. I will say that till I'm blue in the face. Guys, I say it to myself every single day, and I've been saying it to myself for 15 years. I keep repeating it over and over. That's literally what I do every single day to myself. Paul, when you buy this stock, you're buying a piece of a business. You're never going to buy the exact bottom. You're never going to sell at the top. So whenever you buy it, expect the opportunity to be able to buy it for a cheaper price, because you'll never buy the exact bottom. All right. So some high level things on Nike. $175 billion market cap. That means if you bought every share outstanding, that's what it would cost you at market price. Now, enterprise value is $188 billion. That's if you bought every share plus all the debt, netting out all the cash and cash equivalents. So essentially the number in between, the $13 billion in between, is their total net debt. All right. PE 32. 5-year PE 37. Sounds high, right? The historical average is 15 or 16. And this is a high number, but remember, you should be willing to pay a premium for companies with a lot of revenue potential, growth potential, and a high return on invested capital. That means when they invest money in the business, they get a high return on that money that's invested in the business. And there are 2 ways to invest money in the business: debt and equity. So those 2 ways, either you borrow money and put it in the business, or you take your own equity or other people's equity and put it in the business. So we don't know if this is high or not yet. That's what the stock analyzer tool is for. Profit margin, pretty consistent. 5-year average is 10.9, 1 year is 10.8. Okay, pretty consistent. Gross margin, 44%. That means every unit they sell, they make about 44 cents of that in order to pay taxes and profit. All right. Dividends. Oh, I didn't realize they had this dividend. 1.2%. Eats up $2 billion of their free cash flow. And this is why we put the free cash flow here in our software. We want you to compare the dividends to the free cash flow. There are so many dividend kings out there on Twitter. And by the way, I'm very active on Twitter, so follow me there. I'm very active talking about investing and economics and everything. And the thing I don't like is people focus too much on the dividend. You got to make sure the dividend is affordable and safe. And a company should not pay a dividend if they have a lot of reinvestment opportunity or have very, very cheap shares. I'd rather have them investing in the business and really driving up that net income. Or if the shares are cheap, buy back your shares. The reason being is only if it's cheap. Because I want to reward investors. Hey, you investors stuck with us, we're going to have your shares end up being a bigger piece of the pie. That's what you do. That's what the company does when they're buying back shares. They're giving you, the investor, a bigger piece of the company because your shares stay the same. So if there are 10 shares outstanding, you own 1, you own 10% of the business. If they buy back 2 more, you still own 1, but now the profit's only divided by 8 shares. So you now own 12.5% of the business instead of 10, just by sitting there and relaxing. And also, the earnings per share goes up and the price goes up. Look at NVR, look at AutoZone. Those companies bought back a ton of shares that were cheap, And look at their stock price, up 100 times in 20 some years. Incredible. All right. So anything else I want to go over here? Oh yeah, look at this. Remember I said you want a high return on invested capital? 20.5% for the last 5 years, 19% last year. That's incredible, guys. This is the sign of a moat. And can we all argue, is there any argument to be made that Nike is not a moat? I mean, come on. They've got LeBron, they got Jordan, they got all these great stars out there. They got Tiger. I mean, come on. This is obvious to me. They're a moat. Do they still have Tiger? Or is he not with them anymore? I think he's still with them. They had Tiger at one point, or maybe they still do. Let's see if Tiger is endorsed, because I don't want to sound... I think he is. No, he is, because he wears a Nike shirt. Yeah, he is. Endorsement Tiger. Yeah. He's still there. Why was I questioning that? All right. Let's see. What else can I look at here? Year to date, it's down 4.5%. Okay, it's rebounding a little bit. It's only down 2.3% now. Okay, maybe it'll end up being okay. Let's go to our 8 pillars. Oh, let's look at the income statement here. I want to show you some revenue growth numbers. Oh, here's my Twitter. I'll get rid of that. So it was pretty slow and steady, and then started COVID, it dropped a little bit, and then boom, back up again. So revenue's back up to growing, and inflation's going to help this, because if all of a sudden everybody's income doubles and costs double, what's going to happen to their revenue? It's going to go up. Let's look at the 8 pillars here. Now remember, if you have our software, you can customize up to 12 pillars. And if you're interested, go to everythingmoney.com. There's a special, $7 for 7 days, $1 per day. Check it out for all of our software, all of our tools, the community, etc. So like I told you guys, look at the 5-year PE, 37. 5-year price to free cash flow, 40. Oh, that's bad. That is not good. That's high. Cash flow has fallen in the last 5 years. That could be temporary. So one of the things they announced, let's pull up their actual press release. So we're going to go to Nike earnings press release. And this is what I do, guys. I'm showing you exactly how I look at this. I'm going to pull it up right here. Quarterly earnings. 2023. Boom. Plans to release, okay, June 29th, approximately 1:15 p.m. Oh, Pacific time, which is 4:15. Did they actually... Where's the release, though? Is this it right here? Opening document. Please open the document. Here we go. All right. Full year reported revenues are $51.2 billion, up 10% compared to the prior year, and up 16% on a currency neutral basis. So they factor out currency fluctuations, etc. All right, fourth quarter reported revenues at 12.8%, so up 5%. So it looks like their growth slowed in the fourth quarter compared to the previous year. Let's see, Nike Direct reported, wholesale reported revenues for the fourth quarter were down 2%. Okay, so that could be okay. Wholesale being, when they sell to other stores, things like that. If they're selling more directly, that's going to really drive up their profit margin. Because imagine, if they want to sell a shoe for $200, if they go to Dick's, they got to sell it to Dick's for less than $200. But if they sell to you, the consumer, guess how much they're charging you? $200. So they're getting that difference between what they sell at Dick's Sporting Goods and the consumer. That's all going to them. So that would drive up margins. All right. Gross margin for the fourth quarter decreased 140 basis points to 43.6. My guess is that it has to do with this inventory problem. There is an inventory issue. Let's see. Let's look at revenues for the Nike brand. We're up 12.2%. Converse, we're down 1%. Gross margin decreased. Selling and administrative expenses were up 8%. Okay. Effective tax rate was 17.3%. Net income, look at that, was $1 billion, down 28%. Wowzer. And the earnings per share were 66 cents, down 27%. All right. Okay. Let's see. Is there anything else in here we want to look at? Inventories were $8.5 billion, flat compared to the prior year period. Cash and cash equivalents and short-term investments were $10.7 billion, which is $2.3 billion lower than the prior year. Cash generated was used for share repurchases. Poop. And $500 million of debt. Okay. Dividends. Why do they buy back shares? Oh, Nike. Guys, when they're buying back 40 times earnings or 30 times earnings, they're buying back expensive. It's no different than buying another company that has expensive shares. I really, really hate that. I can't stand that. Crap. Okay. Conference call is going to be on. It's on right now. So check it out if you want. All right. Analyst estimates. All right. Analysts had expected $3.27 per share in earnings for this quarter ending. How did it go for the year? So did we have that for the year? Oh yeah, it was over here. Let's see. Fiscal income review. Selling administrative. I can find it by adding the 66 cents to whatever the previous quarters were. Let's see here. So I'm going to go to our software. We know it's 66 cents now. So I'm going to go per share quarterly. Per share quarterly income statement. All right, so net income per share, 94, 85, 80, and now 66. So 0.94 plus 0.85 plus 0.8 plus 0.66. They reported 325. The average for the year, the average analyst had expected 327. So they missed slightly. Okay. And the range was 305 to 362. But it's very close, and they can always alter. After the first three quarters have happened, they can all alter all the way to the end of the date. But they're looking for basically doubling that in the next 4 or 5 years. 1, 2, 3, 4, 5. So doubling their earnings per share. Currently, they're selling for 16 times 2028's profit. That seems like a lot. Revenue growth. Mid-high single digits. Okay. About what I expect for Nike. They're big. And they're probably going to grow as the world economy grows and incomes grow, et cetera, and enter some form of business, increase their margins, et cetera. I think, yeah. Okay. So let's get the stock analyzer tool. Now, on the stock analyzer tool, the reason it's so popular is because it allows you to literally make your assumptions about the future, not including the balance sheet. And when you make these assumptions about revenue growth, your profit and free cash flow margins, assign some multiple at the end, the final step is to put your desired return in. And it'll tell you, here's the price you need to pay. But we also added something to the very end. It'll tell you that if you paid today's price of 113, it'll tell you, okay, if you pay 113 and these low numbers occur, here's the return you'd get. Middle numbers occur, here's the return you get. High numbers occur, here's the return you get. Now, there's so many of these things we don't know, but that's why I put ranges in here. We don't know what the PE is going to be in 10 years. I have no idea. But historical average is 15 or 16, and I'm going to go up based on revenue growth and return on invested capital or moat, and I'll go down based on those two being crappy. But I think for Nike, I'm willing to pay a premium for Nike because it's that brand. It's the moat. If I said to you right now, sporting goods, shoes, what are you going to say? Nike. You're going to say Nike. That's just the way it is. So I think that deserves a premium. Absolutely deserves a premium. So I'm going to do a 10-year analysis. You're allowed to do up to 20, 1 to 20. So revenue growth. I'm going to do 4, 7, and 10. 10's high, guys, but maybe it happens. Profit margin, I'm going to do 10.25, 11, and 11.75. They get more higher margin because they're selling products directly to consumers more and more. Now, their free cash flow is about 1% lower. So I'm going to go 1% lower on the free cash flow margin. Now, for PE, like I said, guys, I'm starting at 15, and I'm going up from there because look at the ROIC. This return on invested capital is a reason we put it up here at the top. I want you to compare and look at it going, hey, 5 and 10 years is pretty close. Even the 1 year, pretty solid. That's a high return on invested capital. So I'm going to go 15, 17 and a half, and 20. And finally, for my desired annual return, you can get 9 or 10% in the very long run in the market. You have to decide for yourself what you want to own Nike for. We've already beaten it up over here. So is 10% enough? Is 8% enough? Is 12% enough? That's what you need to decide for yourself. A guy like Warren Buffett with so much cash out there that he can't possibly invest at high rates of return, he might be okay saying, listen, I'm okay owning Nike at an 8% return because it's a moat, it ain't going anywhere, I like the balance sheet, etc. I have no idea. But for me, I'm okay with 10% on this low side and going up from there. I'm gonna do 12 and 14%. That's pretty standard for me when I do a 10-year analysis on a big business. You know, back in the day when I did a lot more one-off companies, like the small companies that were value plays in the short run, but I didn't want to own forever, I wanted much higher numbers because those are one-off plays that I have to sell off once they're done. My method has changed though. I want to start buying better companies at better prices, okay? Great companies at great prices. So I want to own them for a long period of time. I just want to ride them out. I would be surprised if 30 years from now, Nike didn't exist. I'd be shocked. So I look at that saying, okay, what price am I willing to pay for Nike today to ride along with them? Now, again, guys, the software, including all these tools, are available for you. Everythingmoney.com, $7 for 7 days. Worst case scenario, if you're new to the channel, subscribe. Trust me when I say you'll learn a ton from it. Hit the analyze button. Stick with me for just 1 more minute. That's all I'm asking for. 1 more minute of your time. All right, guys, I have a low price of 45 to 50, high price of 75 to 82, a mid price of 60 to 65. If you put today's price, you'd make negative 1.5% returns if the low numbers occur, 3.5% of the middle numbers occur, 8.5% of the high numbers occur. I have it on my watch list at 59, which is currently the middle number on discounted free cash flow. Again, thank you very much, guys. You can add this to your watch list just by hitting the check mark, and it'll notify you on your email, app, and computer when the stock hits that price. It's a ways to go, but go look at some of the great companies. Google, Apple, Microsoft, all those ones, they fell a lot last year. It can happen. Take care.